Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs, and let's get you up to speed on the market action as earnings season kicks into high gear this week. You're looking at the major averages not too far from the flat line. Of course, the focus is later this week when we get earnings from some of the mega cap tech companies, but you're looking at the Dow barely holding on to gains up just about 26 points. S&P and Nasdaq, though, trading below the flat line. Nasdaq, the worst performer of the three, as we see a number of the tech companies here under pressure this afternoon. Nasdaq off about 0.3%.
And media mayhem. 3 networks, 3 public companies, 3 major changes. The implications from the shakeups at Fox News, CNN, and NBC. Straight ahead.
And Bed Bath bye-bye. The retailer filing for bankruptcy protection and is shutting down. What you need to know as a customer and as an investor.
But first, let's get you up to speed on the latest media news. The theme of the day, firings. Fox Corporation shares sinking about 5% initially when news broke that Fox parted ways with its star Tucker Carlson. They have since rebounded quite a bit. Shortly after that, Don Lemon tweeted he was fired by CNN after nearly 20 years at the network. And a change at NBC. NBC Universal CEO Jeff Shell fired after an investigation into inappropriate conduct. Yahoo Finance senior reporter Ali Canal here with the details. Ali, a huge titanic shift in the cable news atmosphere.
Oh my gosh, what a wild 24 hours it's been. Let's start with the latest and work backwards because there has been so much that's happened. First, Don Lemon out at CNN after 17 years. There was no explanation to why he was fired, but he did publish a statement on Twitter saying he's stunned that management did not have, quote, the decency to tell him directly about the firing. Now, CNN did respond in a statement of its own saying Lemon's recount of the events is inaccurate, writing, quote, he was offered an opportunity to meet with management, but instead released a statement on Twitter. Now, for some context here, Lemon has had some controversy recently, the most notable being his comments about women. He said on his show that a woman is only considered to be in their prime in their 20s, 30s, maybe 40s. That obviously caused a bit of a storm there after he said those words. And remember, CNN is in the middle of a very intense rebrand right now, so I wouldn't be surprised if that factored into the decision. But it wasn't the only major bombshell network announcement that we got. Tucker Carlson, he's out at Fox. This came as a shocker. As you were mentioning, Dave, shares of Fox fell as much as 5%. They've recovered a bit since that time. But the news comes less than a week after Fox settled a defamation lawsuit brought on by Dominion Voting Systems for nearly $800 million. It's unclear whether Carlson's firing was related to the lawsuit, but it is clear that his show brings a heck of a lot of viewers to the network. According to Nielsen, the program averaged 4.2 million viewers during the week of March 27th to finish the week as the most watched cable news program. So he clearly is this force at Fox, and I'm curious how that will impact their viewership numbers. But 2 really big heads, talent at this company just out.
Yeah, certainly a massive 2 shakeups there.
Yeah, I mean, I think the Don Lemon story, not a lot of shock across the industry because there was the news that you iterated, but Tucker Carlson, this came out of the blue, has to have something to do with the $787 million settlement with Dominion. We just don't know what. And so there's a lot of questions about that one. I think there's not as many questions about what led to Don Lemon.
Yeah, exactly. But I also just think the timing, though, is interesting, right? Just given the fact that the comments that he made was several months ago at this point, 2.5 months ago. So the fact that it took so long for CNN to come to this decision, I think is interesting when you take into account that.
We don't know his contractual status. Maybe it was coming up around now. We'll talk to Brian Stelter straight ahead.
That's a very good point. All right, Ali, you also mentioned off the top there the firing of Jeff Shell, the NBC Universal CEO. What are we learning about that today?
Well, we know it was related to an inappropriate relationship he had with a female staffer. Now, Shell, he had been in this role, CEO of NBC Universal, since January 2020, just a few months before the pandemic really upended the industry. He led the company through that. He has been at Comcast since 2004. There have been a lot of changes at Comcast with the growth of Peacock. Also, that Hulu deal coming up. Remember, Disney owns 2/3 of Hulu. Comcast controls the rest. So a potential deal there that Shell was supposed to lead. Now that's not happening. They have a big hole to fill there. Speaking of Disney, they are in round 2 of their layoffs this week. More layoffs coming for CNN, entertainment division, the parks business. So all of these companies just going through a lot right now, a media reckoning for sure.
Certainly a media reckoning, and it's only Monday, so We'll see what other headlines develop later this week. Alec and Al, great stuff. Thanks so much. All right, well, let's dive deep into this. And for that, we want to bring in Brian Stelter, Vanity Fair special correspondent. Brian, it's good to see you here. So lots to get into. Let's start with Tucker Carlson, the firing that just took place today from Fox. It was enough to worry investors. We saw the reaction in Fox shares today. What do you make of this decision and what his exit essentially means for Fox?
Well, it's the craziest day in cable news history between these two deals. And, I'm glad I got a huge coffee at Dunkin' Donuts this morning. I needed every sip of it. I think Tucker Carlson, that part is truly shocking. He was the biggest star on Fox. You just heard the ratings. The ratings speak for themselves. The ratings gave Carlson tremendous power. But at the end of the day, this is a reminder that all those stars on TV, they are just renting. The real owners are the networks. And today, Rupert and Lachlan Murdoch made that incredibly clear by firing Tucker.
Yeah, and we've gone through this before with Fox. Everyone said they were done when Bill O'Reilly was fired. Everyone said they were done when Glenn Beck was fired. Neither built much of a destination elsewhere, and the network has been just fine. I presume they will be as well. They're down 5% initially on this news, have since recovered the stock. So is it an overreaction? I know you're not a stock guy, but do you think Fox will be hurt long-term by his departure? And if I can ask, what happened here? Does that have something to do with that Dominion settlement?
I believe it does with Dominion, and here's why. We all saw the messages that came out in the pretrial legal filings. Tucker Carlson calling Trump a demonic force, calling him a destroyer, Tucker insulting Fox's journalists. But here's the thing, Dave. There's a lot we don't know from those filings. There were hundreds of pages that were redacted. Now, here's my theory, and right now it's only a theory. I believe whatever came out in that process of discovery, Dominion's lawyers have the emails, Fox's bosses have the emails and texts. I think Tucker Carlson must have been saying some things that led him to be fired. We don't know for sure, and Tucker's not commenting yet, but that's why I think this is related to Dominion, because Dominion unearthed all of Tucker's deepest, darkest secrets, all the things he was saying in private. And Fox's bosses were able to read his messages. So that's my theory of the case. We will see if Fox ever admits it or not. But I think the reason why the stock is reacting the way it is because Tucker was the closest thing to someone who's bigger than Fox, bigger than the network. I agree with you that we've tested this theory before, Dave, but this is the ultimate test of the theory that the network is bigger than the star, that even Tucker is not bigger than Fox. And look, you were at Fox for years. How are you reacting to this?
Well, look, I have... Sometimes I react as not someone who worked there because it was a dramatically different network in 2008.
Yeah,
I should say, Tucker Carlson replaced me on the weekend bench. So it's not as if he came...
I forgot about that.
Yeah, it's not as if he came in as a big star. And that's my point. They make stars. They'll find another one. I'm not sure if it's Jesse Waters or if it's Will Cain, who I would keep my eye on Will Cain there. So my reaction is just shocked initially because he makes so much money. Fox Nation might be the biggest impact because people are canceling subscriptions right away. He owns his content there. That will really hurt. But in the long run, they will make another star. So that would be my initial reaction, Shauna.
Yeah, exactly. All great points all around. And it'll be very interesting to see who Fox News does decide to replace in Tucker Carlson's time slot because it is such a coveted time slot. Brian, we also got to ask you about another big headline of the day, and that, of course, was Don Lemon. The parting of the ways is how CNN phrased it. Between those two, you worked at CNN for over a decade. Don Lemon, obviously a former colleague of yours. What's your reaction to this and why you think CNN came to this decision today?
Well, Dave and I are both former CNN anchors. I think neither of us are surprised by this one. This was signaled a while ago when new management came into CNN last year. My show was canceled last summer, and it seemed like Don Lemon might also be on thin ice. He was moved from primetime to the morning, given a chance in the morning. That show did not seem to be going very well, although I loved watching it. I love all three hosts, but it had it was a difficult launch for that morning show. Look, why now? Why Monday? I have no idea. The timing makes no sense to me. Why'd they have him anchor this morning morning and then terminate him at 11 a.m.? I don't know. I do know it seems to be a coincidence that Tucker Carlson was also fired. It's the weirdest coincidence I've ever seen in television, but it seems to be a coincidence. I think Don's going to have a lot of options. He's a talented broadcaster, but CNN seems to want to lower the temperature. Don Lemon's a guy who raises the temperature, so that was going to be in conflict.
Yeah, I was definitely not stunned by this one at all. The ratings stunk, and the women had essentially walked away, given what Don Lemon said about them being past their prime. Any names that you've heard that might replace either Tucker Carlson or Don Lemon? My assumption is they'll try and back a truck of money up to Scarborough, but I don't think Comcast is going to let that happen in this environment.
That's very interesting. I don't have a thought on the CNN part. On Fox, I believe Brian Kilmeade's probably going to fill in all this week. His ratings were pretty strong when he filled in for Tucker in the past. But, you know, the sound you hear out there, it's dozens of television hosts calling their agents, wondering if they can get in line for one of these two jobs. You know what it shows more than anything else? That this medium, that video, is still so important for storytelling and news. Even in a TikTok age, even in a Twitter age, even in an AI age, people like to watch people. They want to trust the person on the other side of the screen. And that's important going forward, even as computers try to replace most of us.
Good call. Good call. That's a great point.
Yeah, that is an excellent point there, Brian. And then while we have you, we also want to get your thoughts on the other headline that initially broke yesterday. NBC Universal CEO Jeff Shell, he was out at the network following an inappropriate relationship, following a probe into that relationship. What do you think this means just in terms of NBC's strategy? He was so prominent. He was really steering the ship when it comes to their push into streaming, what that means for Peacock, what it really means for the network down the line.
I think NBC has a strong bench of talent, so I don't think viewers or even necessarily shareholders will feel a big impact from this. But I just, on a personal level, I am baffled about how this keeps happening. We are almost 6 years into the Me Too movement, into this era, and yet it seems that older white men keep relearning the same lesson over and over and over again. And it's a baffling thing.
Baffling, and it also makes you furious when you start thinking about it a little too much, right? Brian Stelter, always great to have you. Thanks so much for making the time.
Thank you. Thanks.
All right, we are just getting started here on Yahoo Finance Live. Coming up, Bed Bath & Beyond filing for Chapter 11 bankruptcy following years of steep losses and several failed turnaround attempts. We'll get expert reaction on what the recent rise in bankruptcies says about the retail landscape. An earnings season ramping up. Microsoft, Meta, Alphabet, and Amazon, all heavy hitters in the tech sector reporting this week. However, investor sentiment may not be painting a rosy picture. We will break down the key things to watch out for. Don't go anywhere.
The retail reckoning comes for Bed Bath & Beyond, a company filing for Chapter 11 bankruptcy over the weekend and plans to liquidate all inventory. What led to the filing and what lies ahead? Jerry Storch, Storch Advisors CEO, former Toys R Us CEO, former Hudson's Bay CEO, and Laura Cordes, Arizona State College of Law Associate Dean, join us now. Great to see you both. Jerry, we'll start with you. And I have to quote Maya Angelou, because why not? She said, "You can't really know where you're going until you know where you have been." So what was Bed Bath's fatal error, and what does it mean in this retail environment?
Well, they made so many mistakes over the last 5 years. It's hard to pick just one. Essentially, it was very poor execution of the wrong strategy. So they weren't winning on any front. Their prior CEO thought that they'd turn it into kind of a private label shop, almost a second cousin or sister to Target's home department. And really, the positioning they should have had was as the authority for home goods, where you could get everything you wanted, including the best brands. And sure, you could have private label if you wanted, but basically what you needed to be is the authority where you could get whatever you want to ask, go in there, get service, come in with a question, get it answered. And they had none of that. And they went heavily into private label. They tried to do it way too fast. They messed it all up. The stores were a mess. They had stickers all over the windows. For goodness knows what, a huge violation of common visual merchandising rules. It looked like the whole place is going out of business, when in fact what they're trying to do is bring it into the current era. It was a total travesty.
Jerry, what about the value, though, that's still left? Lots of focus on Bye Bye Baby and what that could potentially mean here for the company. What does that value, do you think, realistically look like at this point?
Well, it's deteriorated significantly. So the question is the value still there? There's clearly very little value in the core Bed Bath & Beyond chain. Someone will buy the intellectual property and use it for online retailing or a store within a store at Macy's or something like that. But Bed Bath & Beyond, as we know it, is dead. The real question is Bye Bye Baby. There's no doubt that a year ago they still had value because they're the only baby chain left in the world after Babies R Us went bankrupt along with Toys R Us. So it was the dominant and only dedicated babies chain in the world. They were not doing that great a job, but it was clearly the crown jewel. But keep in mind, babies only take, last I saw 9 months to cook. And so they've been performing so poorly for over a year now that they've probably lost a big part of that franchise as well in terms of the customers who have moved on to Target or Walmart or Amazon. So it'd be very difficult to restart that and bring it back to the strength it had a few years ago. So it's not clear, like it was maybe a year ago, that someone want to buy that and operate that as a standalone business. It's possible. That piece is possible, but I still think that would be a long haul for anyone at this juncture.
Certainly there's some value in the name and social media feeds and whatnot. Laura, to Jerry's point, this was years in the making. How long and how does this procedure now, the filing, take place?
Yeah, so this has absolutely been a long time coming, but now that Bed Bath & Beyond is in bankruptcy, it's actually probably going to move pretty quickly to liquidate, to close its stores, or possibly, as Jerry said, maybe find a buyer for some of its brands. It was able to secure funding to operate in bankruptcy, and it's going to probably put into effect a liquidation plan. It seems like it's planning right now to have all of its stores closed by June 30th. Although, of course, if they're able to find a buyer for some or all of its brands, it might not have to close all of those stores. But now that it's in bankruptcy, it's going to be moving, I think, pretty quickly.
Laura, what does it mean for shareholders? We talk about Bed Bath & Beyond as a meme play. It seems like they're pretty much out of luck, right?
Yeah, so in bankruptcy, generally speaking, those shareholders are at the end of the line in terms of priority. And so typically what happens if something like this is going to happen, it's the creditors, the banks, the lenders that are going to get potentially new ownership in any sort of reorganized company. And those shareholders are typically wiped out. So not good news for the shareholders.
Indeed. All right, Jerry, are there any winners in this story, whether it be a Walmart or a Target or even those in the e-commerce space?
Honestly, they took the share a long time ago. They've been declining at 20, 30% year over year in sales for 2 years now. So there isn't that much business left to be had. that they haven't already taken, but their business will go to places that have good registries for wedding registries. It will go places that have strong baby departments and baby registries. So it's going to go to the guys who are already big. It's going to go to Target. It's going to go to Walmart. It's going to go to Amazon. And whatever's left, if there is anything, will just get split up. I don't think anyone's even going to notice. That's the sad truth. At this stage, it's gone so far south, and it's gone so far south so fast. There isn't that much left in terms of spoil to divide up. And I will say, once you get your hands on this company, once it becomes part of so-called, restructuring experts running it, which is where you are now, between the fees for the restructuring experts, the fees for the bankers, the fees for the lawyers, while the consumer experience is worse than ever, I don't think there's much of a chance that it's going to be anything except a bunch of vultures dividing up whatever's left, giving it to the highest tiered creditors, as Laura said, and then going out of business.
Laura, given the environment right now, consumers obviously pulling back on spending, what do you think this tells us just about potential future bankruptcies, not only within the sector, but really just across the landscape?
Yeah, so I think there's, it's kind of a moment of reckoning in some ways, although in many ways there's been this moment of reckoning for several years now. We've seen so many retailers really since the pandemic filing for bankruptcy for various reasons. And we've had, even just this year, we've had numerous bankruptcies from other retailers. David's Bridal is back in bankruptcy for a second time. We've got Party City, Serta Simmons. And so this is really, I think kind of a moment in retail that it's been having for several years. Unfortunately, what bankruptcy cannot do is sort of change the underlying operations of a company or make that company relevant to shoppers or repair damaged relationships with vendors. And ultimately, a lot of that's going to be up to management. So bankruptcy will give a company breathing space so that management can rethink a company's operational strategy. But at the end of the day, the long-term success or failure of these retailers is going to depend on management and going to depend on the overall retail and economic and consumer climate and other factors that bankruptcy isn't really going to address.
And Jerry, finally, do you expect that there are others that may follow in the Chapter 11 path? And if you could wager a guess, what happens to the minimum 30 million square feet that Bed Bath & Beyond vacancies now combined with maybe Party City and others? What becomes of all that massive retail space?
So firstly, I do think there'll be more bankruptcies. In fact, retailing it's going to be a very tough year. I think Christmas is going to be really hard this year. We have now clocked as of the March sales report. It's now 7 straight months where year over year retail sales have declined versus the prior year on an inflation adjusted basis. So we're going backwards in the retailing of things right now, and there's no sign that's going to change. It appears to be decelerating at a rapid rate. And along with that, anyone who has a weak business model is going to suffer. So definitely there'll be more bankruptcies. There is a glut of retail real estate out there already. The best sites obviously get taken very rapidly. And some of the Bed Bath & Beyond sites are very good. And so those will be used by the retailers who are thriving and value-based retailers. There's plenty of people doing well, value-based retailers, grocers, Walmart, Target, etc. There's plenty of good performing retailers right now. So they'll take the best sites. The worst performing sites, there's already a lot of derelict sites in the worst parts of the worst towns. And I think they're going to have to go to other uses, whether that's, medical is a big one these days, for imaging centers or emergency center, whatever like that, and some of it will just be demolished, frankly, to make way for housing, which has a big need, and for industrial or commercial use. So it's that we're overbuilt. We know that we have too much space. The good space will will always be great. The bad space is what's going to have to go away.
More Harvard healthcare is coming to your neighborhood soon. Jerry Storch and Laura Cordes, thank you both. Great conversation. Appreciate that. Coming up, a busy week for tech. Microsoft, Meta, Amazon, Alphabet, just to name a few, all scheduled to report. We'll tell you what investors should be looking for in their quarterly releases. Next. All right, it is a big week for tech. Check out the calendar. Amazon, Alphabet, Microsoft, Meta, all in focus as earnings season is off to a better than expected start so far in 2023. Tech has seen their shares rebound after a down year in 2022. Tech-heavy Nasdaq up over 15% since the start of the year. So what can we expect from these heavy hitters? Let's bring in Veronica Willis, global investment strategist at Wells Fargo Investment Institute. Nice to see you, Veronica. So broadly speaking, what is your expectations for those tech heavyweights if thus far has been better than expected as far as earnings go?
I think there's the potential that those earnings could come in a little bit better than expected. But I think what's also important to keep in mind is that even with some of these earnings coming in better than expected so far this earnings season, we're still seeing a contraction compared to last year. And so that's something that we've got to watch out for looking forward at this quarter and next quarter's earnings, that potential that we might see that earning contraction for 2 quarters in a row.
So Veronica, what does that mean for the gains that we have seen since the start of the year? Are we going to start to see that momentum fade quickly?
There's definitely the potential that markets could falter, volatility could pick back up, and the market could start to test the lows. I think what we've seen so far this year fits well within kind of a bear market rally. I'm not very convinced that we've seen the bottom of markets yet. There's a lot of uncertainty to come ahead in terms of global economic growth here in the U.S., and Fed policy.
So when we lop them together, but let's take them separately. Amazon's largely going to be an AWS story. Alphabet probably the digital ad environment. Microsoft perhaps ChatGPT, and Meta probably the year of efficiencies. What one story are you watching that'll give you the best sense of where the economy is?
I think the big picture for the economy is looking at these bigger companies and seeing kind of where the quality is and what might be able to better withstand an economic slowdown. So we're looking for areas that will be a little bit more resilient than others throughout a lot of turbulence.
Veronica, what are some of those areas?
Right now, sector-wise, we do like the tech sector, we like the healthcare sector, and we like the energy sector. We think these 3 sectors are best positioned to withstand some uncertainty with the economic situation.
Big tech's bounce back would imply to some that the Fed tightening is over. You think not so fast. What do you see coming in the next 2 Fed meetings?
We think that the next meeting in May, there's probably going to be a 25 basis point rate hike, and probability is pretty high that there will be another 25 basis point rate hike in June. The Fed is watching inflation really closely, and inflation is still not where they want to see it. And that's their primary objective, to get that inflation down. The economy has so far still been able to withstand what the Fed has done. And I think we're not going to see that slowdown in economic growth until the second half of the year. And so the Fed is going to do what it can in the first half of the year before we start to see that decline in economic growth.
Veronica, what do you think that slowdown is going to look like? Is a recession a sure thing?
I do think there will be a recession later this year. Not expecting it to be a very severe one, a moderate recession toward the second half of this year with the recovery in 2024.
All right, Veronica Willis, thanks so much. Great to have you here. Certainly a huge week ahead for the markets. All right, Wall Street is looking to a number of measures of the health of the economy and whether or not there are any signs of a recession. Well, one of those metrics is the performance of the Dow Jones Transportation Average. And we take a look at the performance that transports have underperformed the Dow since early February. And many say that that might indicate economic weakness. Here to explain is Yahoo Finance's Ines Ferre. Ines?
The Dow Jones Transportation Average is actually the oldest U.S. stock index still in use today. In fact, the Dow Jones Industrial Average grew out of the transportation index, which at one point was mainly composed of railroad companies. Now, the Dow Jones Transportation Average is a price-weighted average of 20 stocks traded in the U.S. The index includes airlines like Delta and American, rental companies like Avis, delivery services like FedEx and UPS, and rail and trucking like Union Pacific and Landstar System. The average is seen as a barometer of the health of the economy. Now, some investors stand by the Dow theory. This theory states that if the Dow rises while the transport average falls, that may mean weakness in the economy ahead. Now, when the indices diverge, the market may be anticipating weaker demand for the transportation of goods and services, as would be the case in a global recession.
All right, makes a heck of a lot of sense. Ines Frey, thanks so much. Coming up, C3 AI shares falling today on a downgrade from Wolfe Research. We'll tell you why when we come back.
Earnings, and more earnings. It's a big week ahead for investors. All eyes focused on the tech titans lining up with their latest earnings report. Here's what you need to know. First up, it's a doubleheader Tuesday with Alphabet and Microsoft set to drop Q1 financial results after the close. Alphabet investors will be watching for details on the company's AI investments, while Microsoft shareholders want to know if Microsoft Teams has acted as a tailwind for the company's growth. Next up, Meta. The company formerly known as Facebook will report first quarter earnings on Wednesday. While Meta has been making headlines with the latest round of layoffs, investors are likely to keep an eye on the company's monthly active users and its new strategy, the growth of the metaverse. And rounding out next week, Amazon will report on Thursday after the close. The company recently joined in on the AI race, but will their bet on artificial intelligence pay off? Investors will be listening for AI mentions on the call. We will have all that covered on Yahoo Finance, and tune into After the Call Tuesday, Wednesday, and Thursday with a breakdown of the big tech earnings calls.
Time for a triple play. Three stocks that we're watching in the final 30 minutes of trading. We've got C3 AI, Johnson & Johnson, and Getty Images. Starting it off with C3 AI, the stock taking a pretty big hit today. You can see it off nearly 11%. The drop following a downgrade from Wolfe Research, now cautioning investors about chasing this year's massive rally in shares. It has certainly been an investor favorite over the past several months, really riding the AI hype that we have seen pacing some of the tech gains so far this year. But Wolf analyst Joshua Tilton is warning of slower growth, saying that C3 AI's recent switch from a subscription-based pricing model to a consumption-based pricing model is going to be a drag to revenue growth. At least that's what they believe. Now, earlier this month, shares of C3 AI were also hit after short seller Carisdale Capital alleged some accounting issues with the company. C3 AI, though, disputed that, so helping cushion some of those initial losses. But Diane, when it comes to the fact that the hype around AI, whether or not that's warranted, whether or not it's going to be the next metaverse, that certainly is what the street seems to be debating at this point.
And is this a stud turned to a dud now? I mean, has some of the luster come off of a high-flying stock? It's certainly seen a major run-up, and now some of the shine is coming off. You have all this, I mean, Wall Street's a popularity contest. Look at the pandemic high flyer. So right now we're in that AI generation, and is some of that shine coming off right now? That's what appears to be happening, at least today.
Come on. You got to bet big on C3 AI. My read of the Wolf Research note is that they're more concerned about a slowdown in spending in the short term as the economy pulls back a little bit. But this is, if you're betting on C3 AI, you're not worried about 24 or 25, I hope. If that's your play, you should be betting on 2030, 2035. And ultimately, that's a big first mover advantage for them. I still think a lot of upside in the long run. Their point is notable about short-term cutbacks in spending, though.
Yeah, but I also wonder just how much of their gains, especially since the start of the year, is simply because they have AI in the name of their company.
Exactly.
If it was just named C3 and they did the exact same thing and had the footprint in AI, we talk about the fact that investors sometimes get caught up in that. It's a sideshow. It's turning out maybe that could be some of the big drivers here.
It is.
We'll see,
it's a popularity contest on Wall Street. Let's switch gears. My pick is Johnson & Johnson today. The stock is getting a small bump. This on news that it is reportedly kicking off its roadshow today. That's according to the Wall Street Journal. It's, of course, trying to drum up interest in the coming spinoff of J&J's consumer healthcare business, Kenvue, which includes brands like Tylenol, Band-Aids, and the now controversial baby powder. J&J trying to raise $3.5 billion in the public offering. The spinoff, Kenvue ultimately plans to sell that troublesome baby powder unit, which has been accused of causing cancer. So they started this a couple years ago, this plan to spin off this unit, and it was following the issues and the lawsuits with regard to their baby powder.
This is a big one. You mentioned the names. It's also $15 billion in sales last year, about 16% of J&J's total. But the big question is tough environment, right? I mean, this is a really brutal IPO environment. $2.3 billion raised to date in 23. Worst start to a year in the IPO market since 2009, Shauna. This is not the time for an IPO.
Yeah, exactly. And that was a point that I was going to make too. All of the data point to the fact that this is not the time to be taking a company public. The appetite there from investors from the street simply is not there. And also when you take into account the fact that the projections is that we're going to see the slowdown get even worse, especially in the second half of the year. That, of course, could potentially have a massive impact on the pricing of this.
The appetite's sure not there in general, but J&J has been planning this for a while, and they've been really trying to offload. Again, this goes back to the issues with their liabilities with regard to the baby powder lawsuits and the carcinogenic potential effects of that. So they're just really trying to get rid of that unit, and they've put everything else within this. So, I mean, sure, they're shopping for money, and they're just going to have to deal with the tight climate that it is right now.
All right, my play is Getty Images, a trending ticker today on Yahoo Finance. Shares of GETY soaring after Trillium Capital proposed an acquisition of the photo company at $10 a share. The deal is pending regulatory approvals and board approval. And Trillium saying in a statement, quote, "We believe that our non-binding proposals might create substantial value for the shareholders of Getty." Now, Getty went public in July through a merger with SPAC Neuberger Principal Holdings that valued the company around $4.8 billion. And back to the buzzword, AI. They announced a partnership with AI visual content tool developer BRIA last Tuesday. They also recently banned the upload and sale of illustrations generated using AI art tools on concerns about the legality of AI-generated content and a desire to protect the site's customers. You can see shares, a massive gain today, up more than 32%. 2% on the day. I think this is an interesting AI look down the road because one of the major concerns is authenticity of photos. People are concerned, even a Morning Consult poll showed 65% of people are concerned about the legitimacy of photos and video. Well, Getty offers that. They are all about authenticity of a photo. I could see that helping them long term. They're getting a great deal at $10.
I was going to say, that is actually a very good investor case right now, because when you take a look at Getty Images, it's hard to really wrap your head around what Trillium wants to pay for Getty. It was essentially double what the stock closed at on Friday.
Hence the pop today.
Yeah, and when you take into account some of the other initiatives that Trillium wants to pursue, they want Getty to improve their partnerships with tech companies, also with some publishers out there in order to help grow their business. But the AI point date that you do bring up is a good one, because that could position Getty in a much more powerful position than they really have been over the last couple years.
And Trillium has been pushing for change for a while, so this was them putting more pressure. It's kind of putting pressure in the back of Getty, saying, okay, fine, we're going to put our money where our mouth is. And, so you can see the value coming to the table now. And to your point about just the issue with regard to authenticity and deep fakes right now, we're living in an era where that happens with regard to video. So Trillium's really putting their money where their mouth is.
Keep your eye on that one. All right, coming up, inflation continues to pinch at consumers' wallets. A new study revealing that dealer markups have played a big role in the rise of new car prices. Got the details for you next. Did car dealers drive inflation? Research published in the Bureau of Labor Statistics Journal suggests they were at the very least riding shotgun. Economist Michael Havlin wrote that paper, and he joins us now. Michael, good to see you. Before we dive into that research, how would you describe how the business model of car dealers changed during the pandemic?
Right, happy to be here, and great question. So in the preceding economic expansion that lasted from about 2009 to about 2019, dealers innovated to a great extent to weather a prior margin compression. So over that 10-year period, dealerships were faced with margin compression, and they responded to that by expanding their sales of financial and insurance products. What happened during the pandemic really inverted those competitive dynamics. So due to supply chain constraints and due to economic stimulus, inventories for new vehicles essentially collapsed in 2020 and 2021. And that allowed dealerships to mark up new vehicles substantially, and markups tripled over the 2-year period. And so their business models, while they didn't do anything new, because inventories were so low, they commanded a great deal more pricing power during the pandemic.
Michael, how big of a driver was that to inflation? We know that car prices obviously contribute to it, but to what extent did you find in your research?
Right. So the range of estimates that I provide in my research is from about 35% to about 62% of new vehicle inflation was due to profit increases, specifically at dealerships. And I look at that range and I say about half. So about half of all new vehicle inflation was due to profit increases at dealerships. And that accumulates into a significant impact on the overall CPI as well.
So I reached out to the National Automobilers Association about this story. Here's what they told me. The argument that dealers, as retailers of commodities with negotiable prices that were severely constrained during and after the pandemic, contributed at all, let alone substantially, to inflation is absurd. What's your reaction to that, Michael?
Well, I'd say the proof is in the pudding, and I understand that the Automobile Dealers Association is just doing its job, which is representing the dealerships. But I'd like to step back and just mention, no one is blaming dealerships for what happened, or some people are, but I am certainly not blaming dealerships for what happened, and my research is not blaming dealerships for what happened regarding inflation. Dealerships are simply acting rationally to the incentives that were in front of them, and that's how our market-based system works. I think when people look to blame certain actors in the supply chain, what they're doing is trying to understand why something occurred and understand how we may be able to prevent it in the future. So to understand why dealerships had such pricing power, we have to kind of step back a little bit and look at what happened to inventories. We had this thing called the pandemic. At one point in March of 2020, factory output fell by 99% in 1 month. When do you see something like that, a virtual 100% drop in 1 month? And there was a ongoing 3 to 5 month deficit of automotive production that the industry never really overcame. And to this day, unfilled orders are 20% higher than they were pre-pandemic. And dealerships get pricing power when inventories are low. Now, what happened later on in the pandemic, I think, is a little bit more interesting. We know what happens with shutdowns. We know what happened with supply chain constraints. But later on in the pandemic, later into 21, 22, automotive manufacturers, and you can see this in any media reporting, began openly discussing the fact that they would like to remain disciplined. And the manufacturers and the dealerships don't want to go back to the high inventories of the prior decade. So the only way that dealerships' pricing power is going to diminish, the only way those margins are going to go down, is if either A, production from the manufacturers increases, or B, consumer demand decreases. And so far, we haven't seen enough of either of those for dealerships' pricing power to diminish.
Michael, are we starting to see that change, though, a little bit? Because the latest data out that we've gotten from Kelley Blue Book showed that new vehicles, the average transaction price did fall on a month-over-month basis. Is that just a one-off, or have we started to see maybe that cycle shift a bit?
Yeah, that's right. There has been some softening in automotive vehicle prices as well as margins. And the logic certainly follows that if profit increases drove vehicle inflation, then certainly profit decreases can cause deflation or at least disinflation. However, to really get that in a sustainable and measurable way, margins have to come down a lot. They've only come down marginally, and they're still double what they were pre-pandemic.
All right, Michael Haviland, economist, thanks so much for joining the program here this afternoon. Coming up, another stock that we are watching, Spotify shares off just about 1.5% ahead of the company's quarterly earnings report tomorrow. Wall Street believing that the streaming service is shaping up quite nicely for their report. What you need to know on the other side of the break. Spotify shares trading lower ahead of its first quarter earnings release tomorrow morning. Yahoo Finance's Alexandra Canal is here with a preview. Ali, what can we expect?
Well, I think the big things that investors will be watching will center on margin improvements and any conversation surrounding those subscription fees, right? We heard last quarter there weren't any updates as it related to pricing, but I think with competitors hiking prices and especially this big profitability push, higher prices do seem likely down the line. And on top of that, Spotify has made very heavy investments totaling as much as $1 billion in the podcast space. So potentially higher prices could offset that since those investments have been a serious drag on margins. Even during the last earnings call, CEO Daniel Ek admitted that he overinvested, but that the company will be a lot stricter when it comes to that spending this year. They've already cut jobs, eliminated certain initiatives like its live audio initiative called Spotify Live. And on top of that, they've continued to demonstrate growth with monthly active users topping 500 million last month. So overall, Wall Street is very bullish on those possible near-term catalysts. Now, there will be some headwinds here like macro pressures, especially as it relates to advertising. Also, foreign exchange as the dollar continues to remain strong relative to other currencies, but the outlook is bright. Here are some metrics to look out for tomorrow morning. According to Bloomberg consensus estimates, we're still looking at a loss per share, but an improvement over the fourth quarter. Total monthly active users expected to come in at 502 million. But I do think, again, investors will closely be listening on the call for any updates and commentary on margin improvements, pricing, and that macro environment.
All right, certainly we will be listening in for that. Shares so far since the start of the year, up just around 60%?
Yeah, 60%.
So certainly an outperformer since January 1st. Right, Alec Canal, great stuff, thank you. Coming up, we are counting down to the closing bell on Wall Street. Dow, S&P trading just above the flat line. We'll be right back. Under 2 minutes to go until the closing bell. Let's get over to Ines Ferre with a closer look at today's action. Hey, Ines.
Hey, Shauna, and it looks like we are going to end the session with mixed markets, with the Dow and the S&P higher and the Nasdaq down about 0.3%. Watching our Wi-Fi Interactive, we have been seeing some weakness with some of the tech names under pressure, also real estate and financials. The winners today being energy stocks, material, and also healthcare, utilities, some of the defensive names there. Over on the Nasdaq 100, you can see a little bit of a mixed picture here with the mega caps. You've got got Amazon, Microsoft, Tesla down more than 1%. Meanwhile, Apple and Google or Alphabet are in the green. Over on the Dow, also a little bit of a mixed picture. Salesforce down 2%. Verizon's lower. Intel is down as well. And looking where we're at with cryptocurrencies, we have been watching Bitcoin down 0.4%. Bitcoin trading at 27,370 per token. Over on the commodity side, we have been watching oil higher. I had mentioned that energy stocks are higher. Well, WTI crude oil up more than 1%, sitting just above $78 a barrel. Brent crude is also higher. And looking at gold, that's higher as well. Here's a closing bell at the New York Stock Exchange.
Jerry Jones, ladies and gentlemen, and the Dallas Cowboys starring on the closing bell today. The Cowboys owner, that gets me excited for football season. Anybody else? Still a long ways away. Let's check out the markets. Kind of never got out of bed for the most part. It's a Monday, man. That's what happened. The Dow up about 66 points. The S&P, slight gainer, just eking out some wins on the day. And the tech-heavy Nasdaq, the loser on the day, down about 1/3%. And Diane King-Hold now joining us for the rest of the hour. Diane, nice to see you.
It's
you a Dallas Cowboys fan at all? I got to ask. I got to get everyone on record, whether they are or aren't. You're either a Cowboys fan or you can't stand them. There's no gray area. Can't stand them. Yeah. There's no gray area on that.
All right, well, we certainly have a lot to get into over the next 60 minutes, but let's kick this hour off with a couple of the biggest movers of the day. First up, Fox. You're looking at losses of just about 3%. The network announcing that it has parted ways with its star primetime host, Tucker Carlson. Now, this coming less than a week after Fox settled a defamation lawsuit with Dominion Voting Systems, paying out $787 million. But Dave, certainly investors taking issue, or a little bit concerned, maybe I should say is a better word to use there, about this split here with Tucker Carlson, given the fact that he was able to bring in millions of viewers night after night.
Yeah, sometimes it's hard to draw direct causation with the stock, but this appears to be an exact reaction to Tucker Carlson. And let me say overreaction too, because yes, Tucker Carlson is the biggest star at Fox. Trending on Twitter are things like boycott Fox, Fox is over, Fox is done. Not so fast, my friends. This happened with Bill O'Reilly. This happened with Glenn Beck. They will replace Tucker Carlson. They build stars there. People don't turn the channel there. He'll be fine. He'll make some money, but I think that might be a buying opportunity because Fox is going to be just
Sure,
fine.
that stock has been beaten up, though, today. I mean, the move with Carlson being out of the network wipes more than $500 million of market value off the stock. So some shine definitely came off today. Another stock under heavy pressure today, Bed Bath & Beyond, finishing off the first trading day since announcing its bankruptcy. Shares sinking more than 30%, about 35% there. The company had been warning bankruptcy was in its future, but made last-minute attempts, a Hail Mary to save itself. That Chapter 11 bankruptcy notice coming in on Sunday. Final store sales, they begin on Wednesday, so break out those 20% off coupons while you can.
I know, the last-ditch effort really to hopefully maybe get some of the things that do remain at the store right now. But I think just in terms of the future of Bed Bath & Beyond, we talked to Jerry Storch about this last hour, the former CEO of Toys R Us, and it all comes down to the worth here for Bed Bath & Beyond. He was saying that there's very little value in the core business. The big question, though, is bye-bye, baby, moving forward. Right. That value has obviously come off and is really not evaporated, but much, much less than where it was a year ago today. But certainly, maybe we could see some interested buyers in that division.
Might be more name only in terms of their value that's left. I'm really curious what becomes of the real estate. We're talking about 20, 30 million square feet of retail real estate that becomes available in a market that was already struggling. I don't know what you're going to find to fill these spaces beyond some medical in some communities. Some of the winners that have been discussed, is it Walmart, is it Target? Jerry Storch told us that's baked in, and that's why their stocks barely moved today. Amazon perhaps as well.
Or
they're down
IKEA.
slightly. So clearly Jerry's right. Already baked in.
Yeah.
Okay, shares of Microsoft ended the day off as well. You can see down by about 1.5%. Just like every company, it appears to be, we say on AI News, the European Consumer Organization wrote a letter Monday asking the Consumer Protection Cooperation Network to look into ChatGPT, AWS, Google's Bard, and others to examine if they could increase deception, fraud, and misinformation. No idea if that's exactly what is pushing the stock down, but we'll get a much better look at all things Microsoft when they report.
Sure, they'll get some heat from that, but clearly there's some profit taking happening. I mean, it's a big tech week for earnings, so why not take some profits just in case? So that's what I think is at play here.
Yeah, and then there was also the FT report just about no longer bundling Teams with Office. That also the stock took a hit on that. They're hoping to avoid that antitrust lawsuit over in the EU after Slack did complain of anti-competitive behavior there in 2020. But certainly, we're seeing some pullback here ahead of those earnings reports that we've got. What, over the
Microsoft
next
tomorrow, right? I think.
Microsoft tomorrow
Exactly.
and Alphabet.
Can't wait for that one. All right, Coca-Cola, meanwhile, reporting better than expected first quarter earnings. You can see the stock, down just a bit, driven by higher prices, higher demand. But there was one phrase that is raising some eyebrows here. It's the company says it's, quote, exploring ways to leverage AI. It is the theme of last and this earnings period. Josh Schaefer here to take a closer look at the hot new trend in corporate America. How exactly is Coca-Cola going to take advantage of AI, sir?
Yeah, Dave, I think the point here is we could probably talk about this with every company we're going to hear from over the next couple of weeks and have been hearing from, right? But Coca-Cola's specific strategy has to do with art. So you can use AI to create art that Coca-Cola then says they'll take the top art projects and put those out into the world. Basically, one of them is a fun cat with a can. That was one created AI image. That's the lead image
awesome.
on Yahoo Finance right now out on the website. But I think the broader thing here that I was sort of thinking about when breaking this down today is it's really reminiscent of right now it's AI. In 2018, it was blockchain. In 2021, it was the metaverse. Everyone sort of has to mention this right now, right? You go back to 2018, Amazon was telling you that blockchain was going to be a big part of AWS. Look at Amazon's last earnings call. Guess what they didn't mention once? Blockchain. Coca-Cola was in the metaverse 2 years ago. They were telling you about NFTs. Guess what Coca-Cola didn't talk about today on their earnings call? The metaverse or NFTs. So you got to sort of wait to see where this plays out. AI is going to be a part of every company, right? For what it could do for workers, but it's not necessarily an investment play when these companies name them, when they're naming AI. And I think that's the important distinction to make, right?
Yeah, and that is a very, very important distinction to make. And something that you also used in your article was from Baird's market strategist, Michael Antonelli, when he was telling Yahoo Finance that, AI is the second most asked client question just in terms of where they're trying to figure out where they want to put their money. AI is right up there. So that might be, I don't know, some signs that a bubble could be forming within the space, at least for now.
Right.
Yeah, no, and Michael...
From an investor standpoint.
Because what is Coke doing in AI?
Michael's perspective was interesting, right? So he was talking about tech earnings and sort of what to expect in those AI players like a Google and Microsoft, where he was saying, I am watching what AI is doing there. I'm not really watching what AI is doing in the case of like a Coke, right? And I think it's interesting. He said, you're going to see a million ETFs and a million different marketing pitches that come with AI. This is one of those marketing pitches. Where else did we see ETFs? Where else did we see marketing pitches? Right. Blockchain, metaverse. So it's all sort of in that line. But tomorrow, we're going to want to know what Microsoft says about it, and we're going to want to know what Alphabet says about it. So it matters, just in a prism.
James Quincy, the Coke CEO, said this morning AI impacts, quote, their entire marketing ecosystem, not one small sliver. It's not NFTs. We can agree on that.
Absolutely not.
Okay.
Absolutely not.
Huge story.
I'm just curious what the rhetoric is about AI in 5 years.
Or even 2 years from now.
Right?
I'll take the over. I'll just take the over. Josh Schaefer.
You always take the over.
I do, don't I? Good to see you, brother. Thank you. All right, coming up, the extreme bull case for Tesla. We talked to one analyst who says shares could hit $2,000 in 2027. That would be an increase of more than 1,000% from these levels. Stick around for that.
Siri, what is metadata?
So you want to know about metadata? Of course you do. It's come up in a lot of conversations, especially around some of the social media hearings that have taken place on Capitol Hill. So what is metadata? Metadata is essentially the data about data. And to break that down even further, say you post a picture. That picture, even when you've taken it, already has the location that that picture was taken at, the date that it was taken, the type of camera that you were probably using. Those three things and more amass the metadata. But here's where it comes into play for some of the social media companies, is because when you post that image, you are essentially giving that metadata over to the social media companies, and you're allowing them to then catalog some of that metadata and create an advertising profile on you that they can then index and be able to resell to other advertisers. So for social media companies, that metadata is incredibly important. There's some data that you volunteer when you sign up for a profile, but there's other data that you're giving them not even knowing it. And that is how you get advertised to on such a granular level, and why some of those ads are so relevant. I missed the cup.
The earnings parade continues. General Motors gearing up to report its results tomorrow morning before the bell. Here with what to watch is Yahoo Finance's Pras Subramanian. Pras, tell us what we can expect.
Hey, Dan. So I'm watching profitability and GM's EV rollout here in focus. Looking ahead to tomorrow's report, looking at revenue around $39.23 billion, a slight dip sequentially there. Adjusted EPS of $1.72 a share, and net income of $2.35 billion on an adjusted basis. That's an 18% jump from a year ago. Now back to that EV rollout. Now GM delivered a record number of EVs in Q1, but only around 20,000 vehicles. Most of those were the Bolt EVs. I'd like to hear more about what's happening with the Chevy Equinox EV, the Blazer EV, and the Chevy Silverado EV. Are those launches going as planned and set for later this year? And will pricing of those EVs be affected? Tesla's big price cuts might have an effect here following that big sort of Q1 with that.
I'm glad you mentioned Tesla. I mean, it's revving up to shell out billions in capital expenditures this year. Pras, what can you tell us there?
Yeah, so not really a surprise here in my opinion, but they did raise their CapEx spend for this year to $7 to $9 billion, up from $6 to $8 billion from January. Right. I say it's not a surprise considering the company announced its Mexico Gigafactory last month. In the filing today, Tesla said it was, quote,
simultaneously ramping up new products, ramping new manufacturing facilities on 3 continents, piloting the development and manufacture of new battery cell technology, and investing in autonomy and other AI-enabled products. So AI, autonomy, new factories. I mean, you're going to hear more about these things coming up in the next few months for Tesla's CapEx spending.
Yeah, and I mean, Tesla stock took a hit on the news of that. So, Praz, thank you so much for that. All right. And sticking with Tesla, a number of Wall Street analysts slashing their price targets on the stock over the past week. But ARK Invest is bucking that trend, lifting its price target on the stock to $2,000 a share by 2027. Shauna Smith is going to join into this conversation, bringing in Tasha Keeney, ARK Invest Director of Investment Analysis and Institutional Strategy. Shauna, you take it over.
All right, Tasha, let's talk about this very, very bullish call. $2,000 a share by 2027. You're raising your price target when a number of analysts on the street slashed their price targets because they were worried about margin pressure. What are they missing?
Well, I think the concerns over margin pressure are very short-term oriented. We've heard Tesla say this, but we've actually modeled the opportunity in robotaxis and autonomy. And if you look at the future of, Tesla vehicles that are capable, becoming robotaxi enabled, earning a recurring revenue stream at what we think will be software as a service like margins, this is an amazing potential for Tesla. It'll definitely be, the highest return on investment per battery produced, as we've analyzed in our new report up on our website. So I think that, again, this will totally change Tesla's margin structure in the future. They mentioned on the earnings call that they're prioritizing getting cars out on the road. I think that's a smart decision, as opposed to, keeping margins high and prices high in the short term. They just want to get as many cars out on the road as possible. Those cars feed Tesla's data engine, and that's what turns each of them into a fully autonomous car in the future.
Yeah, Elon said on the earnings call he thinks they could achieve fully autonomous this year. Is that your expectation?
So we have a Monte Carlo model with a range of assumptions. The midpoint of our expectation is in 2024. So it'd be later than Elon says. In our most bullish case, I think they could launch fourth quarter this year. But again, the real thing to look at here is, whether or not it's fourth quarter, whether or not it's next year or the year after that, this is an amazing opportunity. We think the market for robotaxis globally could be worth, $9 to $10 trillion in the next decade. So it's clear why Tesla is pursuing this opportunity. And again, with their data advantage and their verticalization, they really could be a leader here.
So, Tasha, that's a little bit down the line. When we talk about maybe the next year or two with Tesla, of course, when they continuously cut the prices of vehicles, a lot of people are asking if there's a demand issue. Are you seeing any sign of that?
So, again, the story here, if you take a step back, is really that EVs are gaining share. So Tesla was harping on this on their earnings call recently, that you should think of them as a share of the total global auto market as opposed to just the EV sector. Because again, in the future, it's going to be electric vehicles. So, my partner analyst, Sam Kors, has done a lot of great work looking at the electric vehicle market. We think that there'll be 60 million units sold in the next 5 years annually. And, that's up from, single digit percentage points as a percentage of auto sales today. So I think that Tesla here is really in the lead. They have a multi-year advantage over competitors. It's, again, that verticalization strategy that keeps them in the lead. So we think on an efficiency basis per cost for the price that you're paying for the car, they're still way ahead of the competition. And, I'd be pretty scared if I were a traditional automaker right now and I saw Tesla cutting prices, I'll tell you that, because not all of these platforms are profitable at other automakers yet.
Yeah, there's some very slim margins, do those traditional automakers. So there are the margin concerns. There's also this group of shareholders that own a combined 1.5 billion in shares. They're concerned about something else, and that is a distracted CEO, of course, Elon Musk. They write in this letter to the board, "We have grown increasingly concerned with governance and leadership issues at the company. Tesla needs a board that will ensure that the CEO is focused on addressing its challenges." Are you concerned about Elon Musk being distracted with Twitter, SpaceX, and everything else he takes on?
Well, it's not a surprise to us to see him tackling many issues at once. As you mentioned, SpaceX, he was one of the founders of OpenAI. We've seen him spread out his responsibilities among his companies. And really, what do we have to go off of? It's his execution. Look at Tesla's progress today from 5 years ago. Again, it's the leading company in electric vehicles. We also think so in autonomy. And I think he's a really crucial figure to actually crossing that finish line to creating a fully autonomous car. So we have full confidence in him as the leader of Tesla, and in fact, we'd be more worried if he were stepping away from his responsibilities. So I think that while yes, it's shocking that he's able to manage this many companies at once, this isn't something that we haven't seen him do before.
You're happy if he stays on board as CEO of Twitter beyond this year?
Yeah, so we are invested in Twitter in our private fund here at ARK. So I think that a lot of the ideas that he's put forward there to have the potential to really change the company and particularly the payments platform aspect of things we're pretty excited about. And our fintech team has done a lot of research there. But again, I think going back to Tesla, I'm not concerned with him splitting his time. We're going off of his execution here, and he's been an amazing leader. He's built an auto company that's really unrivaled in its autonomy and AI advantage, its software advantage, and its battery advantage.
Tasha, what about the Cybertruck? Certainly that has drummed up some excitement. Of course, it was mentioned a couple of times on the most recent earnings call. How important, or is it important at all, to the investment thesis?
What I think is so interesting about Cybertruck is it's just another way that Tesla is really efficiently producing cars. So, the no need for paint or any coating, one single piece over the body of the car. It's a lot cheaper to make than, say, the Model 3. Or at least the frame of it is. So we think that, the next generation vehicle that Tesla announced, which is going to be half the cost of the Model 3 and Y platform, that could potentially be a vehicle that looks similar to the design of the Cybertruck. And again, they do that because it's the most cost efficient way to produce these vehicles. And if you have a robo-taxi fleet, that's bringing down costs, we think that an EV already makes a ton of sense for autonomy on a cost per mile basis. And this is just going to, push Tesla even further over that edge of making an extremely efficient platform that'll lower the cost of transportation for people globally.
All right, Tasha Keeney, ARK Invest Director of Investment Analysis and Institutional Strategies. Thanks so much for joining us here. Well, coming up, another big story. House GOP leaders seem confident that Speaker Kevin McCarthy's bill to raise the debt ceiling is going to pass the narrowly held chamber. But could we see a repeat of 2011? We'll discuss next. A huge test for the House this week as it plans to vote on Speaker McCarthy's debt limit bill this week. Kevin Cirilli, Yahoo Finance contributor, is here. And Kevin, the big question is whether or not McCarthy is going to be able to get the 218 votes he needs. What do you think?
I don't know. I was trying to do the numbers up on Capitol Hill earlier this morning and talking to sources. And look, Republicans don't know if they have the votes here. You've got Speaker McCarthy speaking at the New York Stock Exchange last week. He wants to raise the debt ceiling by $1 trillion and cut some spending in various different programs. That's not far enough for the Freedom Caucus. It's also not moderate enough for the more centrist Republicans, some folks who are in the Problem Solvers Caucus, a bipartisan group, for example. All of this comes as President Biden and Speaker McCarthy have not spoken, and get this, Shauna, more than 75 days on the debt ceiling. So, I think that this is a big week for the market in terms of earnings. But at the same time, if there is this test vote, there's going to be a heightened interest to see whether or not Speaker McCarthy can keep Republicans behind him in the House of Representatives. If he can't, what that signals is that it's going to be even more of a rocky road to get to a bipartisan breakthrough if the Republican Party isn't fully aligned going into the negotiations. Just a reminder that X-date that when we hit the debt ceiling, $31.4 trillion debt is in the nearest term, by most estimates, about 6 weeks out. All the way could be extended through August.
McCarthy was so effective at wrangling all those leadership votes. It's hard to imagine what could go wrong here, Kevin. Meanwhile,
he had to negotiate. Yeah. He had to negotiate on the debt ceiling to get. That's a great point. And quickly, I would just add, he was negotiating over the debt ceiling when he was trying to get that gavel. Now he has the gavel, and he's got to make good to those people that he made promises to.
Oof. All right. Meanwhile, President Biden's re-election announcement video reportedly comes out tomorrow, and an NBC poll finds 70% of Americans say he should not run again. Kevin, is it because of the economy? Is it because of his accomplishments? Or is it because he'll be 82 when he runs again?
The NBC News poll suggests that it's a little bit of all of those factors. Separately from that, Americans don't want a rematch. They don't want 2020 part 2. You've got 70% of Americans saying they don't want President Biden to run again, and 60% of Americans saying that they don't want to have Trump run again. And yet right now, those are the two frontrunners. A new USA Today poll that came out just in the last couple of days had Trump up at like 40 plus percentage points and Ron DeSantis, Florida governor, at 31 percentage points. So, it's looking like we're headed toward a rematch, but Americans don't want it.
No, they don't, man. And Trump will be a spry 78 under indictment. What a rematch we have for the most powerful man in the world, huh? Looking forward to that. Kevin, it's really great stuff. Thank you.
Or woman.
Companies and entrepreneurs are integrating AI into everyday operations, and it's starting to spook employees. A recent survey by Pew Research finds that more than 50% of Americans think AI will hurt workers more than help them. Employees also overwhelmingly oppose AI being used in hiring to monitor workers. 71% saying they are against AI making a final decision. Lastly, 61% oppose AI tracking employee movements while at work. Shauna, how do you feel about AI in the workplace?
And the workplace, well, there was a bit of a disconnect, I thought, within the results of this survey, given the fact that just over 60% do see AI having a major impact on workers in the future, but less than 30% see AI impacting themselves personally at work. So I think there's a lot of disconnect just in terms of how people are envisioning AI, how exactly that relates to the job that they are doing on a daily basis.
It's clear AI is here to stay. The robots are here. So you have to set certain parameters around how it operates. I can understand employee skittishness. We all feel that way. Look, could robots do our job? Some people might say, yes, we disagree. Do they have enough personality?
Nope, not for me, honey.
Exactly. But I was recently at an event, Blacks United in Legal Technology, and they talked about one of the risks with AI is the potential for bias. And there's always initially a human behind it who creates the coding, et cetera, et cetera. So you have to make sure that you take care of potential factors like that. You remember when Amazon had the security issue with regard to some bias being built into their programming that law enforcement was using.
Yeah, I think for most of us, AI will make our jobs more efficient. It'll take care of some of those small tasks that you spend a lot of time, that occupies a lot of your time. But if you're not sitting here thinking, how could AI replace what I do or impact what I do, then you're behind the 8 ball. And if you're going to college, if you're in college, if you're not thinking about how can I take advantage of artificial intelligence, or am I going to into a field that might be eliminated entirely?
Because
you're making a fatal mistake, my friend.
But I also think that it's good to point out, just in terms of this study was just released, but the survey was taken in mid-December. And I bring up that timing because it was just 2 weeks after we really started to hear some details about ChatGPT and what we're getting from Microsoft. And now we have Bard, we have Einstein from Salesforce. So that conversation has really evolved in just the last 3.5 months. So I think, I wonder if more and more people, you would think, are coming to the realization that their life at work, their job, is going to be altered. We don't exactly know how, but it will likely be altered by AI.
It will, and people have to prepare for it and figure out, just like you said, Dave, how can I benefit from this, or how can I utilize this to make myself more efficient in this job, to make myself more valuable?
Certainly, yep, the pressure will be on. All right, well, coming up next, the race to home ownership. Gen Zers are buying up more homes, putting the generation on a slightly better home ownership trajectory than their parents. We're going to take a deep dive into Redfin's new report next.
"25-year-olds with a white picket fence and a mortgage." A new report out from Redfin reveals Gen Z is outpacing their parents' generation for home ownership. Let's break down that data with Daryl Fairweather, Redfin chief economist. Daryl, first of all, thanks so much for joining us. I got to jump right into this. And, you know, there was, we saw in the numbers, there was definitely a difference between millennials and Gen Z. So unlike millennials, it appears that Gen Z can buy a home and some avocado toast. What can you tell us?
Gen Z is doing slightly better than millennials were at their same age. We looked at 25-year-olds, and for Gen Z, their homeownership rate was a little bit above millennials and Gen X, still below baby boomers, but at least the trend in terms of generational homeownership seems to be reversing.
So what do you attribute this to, and what's the impact?
One of the biggest things that millennials had holding them back was the Great Recession. It was a very long recession. Unemployment stayed high for a long time, which was when millennials were entering into the labor force. Many of them moved to expensive areas like San Francisco, New York, Los Angeles to find a job. And those places are really tough places to buy a home. Gen Z, on the other hand, they had the pandemic recession, but that came with stimulus checks. It came with student loan pauses, and there was a really tight labor market. There still is a tight labor market. So if they're living somewhere more affordable, like Virginia Beach, for example, homeownership is more attainable for them.
So Gen Z is, based on these numbers, buying homes where they can afford them, because I can see based on the numbers, how could this happen in, say, the Northeast? But you've said in the data, it looks like they are spending a larger portion of their income on monthly payments. What is the issue for why can't millennials do, or should millennials even do that? I mean, the longstanding idea in, for instance, the personal finance space is you shouldn't spend more than 30% of what you're bringing home on housing. Is Gen Z spending more than that?
Well, Gen Z is buying in much more affordable places, but their incomes are lower. So they do end up spending a bit more if they're going the home ownership route. Millennials, they actually do have the option to move to a more affordable place and buy a home. A lot of that happened during the pandemic, but it was later in life for them. Millennials are getting older. They're in their mid-30s, some are in their 40s. When they were 25, it was a very different housing market, a very different labor market. That's the important thing, where they didn't have the financial security to move somewhere where there wasn't as strong of a labor market and buy a home.
Do you have a prediction going forward, though, about the housing market? There's been a lot of talk about another potential bubble within the housing market. We haven't seen it bust yet. Are there some headwinds that you can see on the horizon that would affect Gen Z, millennials, whatever the generation we're talking about right now?
Well, home prices were down 3% in March, so home prices have come down from last year. I think the gap between this year and last year will widen as we go into summer, but then it will shrink because that's when home prices started going down, was summer of last year. So overall, I think most of the home price correction has already happened. Now, if mortgage rates go up more, we could see prices decline, but I think the direction we're going to be headed in at the end of this year or into next year is that mortgage rates will start to come down and demand will start to come back. It's going to take a lot more for homeowners to come back, though. Inventory has been a huge problem. Many homeowners have locked into 3% mortgage rates, and it's going to take a lot to get them to want to sell and lose that golden mortgage rate they got during the pandemic.
Yeah, hard to imagine rates going anywhere near that in the next several years, isn't it, Daryl? May 1st, everything changes in terms of mortgage fees. How does it change? What do you believe will be the implications?
Starting May 1st, there'll be a slight change in the mortgage fees applied to high credit borrowers versus low credit borrowers. It'll still be true that if you have high credit, you're going to get a better mortgage deal, but it won't be like relatively as big of a gap between when you have high credit versus low credit. This will even the playing field a bit. We've seen a lot of FHA borrowers come back to this market because there's less competition and they can finally get an offer accepted. So that will make things a little bit more affordable for your lower credit, lower down payment type borrower. But overall, it's still better to have good credit. So it's not a huge change. And given the volatility in rates, you might not even notice it because rates keep swinging every day anyway. A small fee you're probably not going to really be able to detect.
Daryl, these headlines and what you're saying has been scaring me. You mean I worked so hard to get, there's going to be a humble brag here, more than 800 points credit score for this kind of marketplace right now. I mean, So what else is on the horizon in terms of the housing market? What are you seeing?
Well, I think it's going to be a very cold housing market going forward for the spring. We have 20% fewer home sales happening right now, and I think that's going to continue until mortgage rates come down, and we're predicting that will start to happen towards the end of the year. So it's just going to be one of those down years. Housing market goes up, it goes down, and it kind of cycles, and this is a slower time.
All right, Daryl, fair weather of Redfin, our thanks to you.
Coming up, First Republic Bank shares sliding as the company detailed how hard it was hit by the banking crisis. We'll dive deep into the company's latest earnings report next.
First Republic shares plunging off just about 15% following its latest earnings release. Now the bank detailing that deposits were down nearly 41% in the first 3 months of the year. That's down from the prior quarter. Here to break it all down, we want to bring in Jason Benowitz. He's CI Roosevelt Associate Partner and Senior Portfolio Manager. Jason, it's good to see you here. So certainly the street taking issue with the fact that we did see deposits drop 40% quarter over quarter. What's your first take at these results?
Yes, so you highlighted what I think is the most important takeaway from the results, which is that First Republic deposits declined. We were all expecting a decline, of course, but it was more than we expected. So, sort of a baseline expectation headed into this quarter was perhaps that, there was a report on March 19th that First Republic had lost $40 billion in deposits, but then, $70 billion. But we also know that they received $30 billion from the consortium of 11 banks and sort of the private sector rescue. And so the net of that, we would have thought that the deposits would not have fallen by the $100 billion that was reported today.
Okay, so from their CFO, Neil Holland, we moved swiftly and leveraged our high-quality loan and securities portfolios to secure additional liquidity, adding we are working to restructure our balance sheet and reduce our expenses and short-term borrowings. How would you characterize their health, and what do they need to do moving forward?
Right. So because they lost so much in deposits, they have to replace that funding somehow. And so they're doing it with borrowing. But the problem is that deposits are a low-cost source of funding, whereas borrowing is a higher cost, and it really is going to weigh on their profitability, both in the reported quarter as well as going forward. So this isn't really a strength of theirs. Now, what they're talking about is, they have to fix that somehow. They have to find new deposits to somehow sort of lower their total cost of funding and repay some of those borrowings. But I continue to wonder how they're going to be able to do that. So this is another concern that sort of flows from the fact that the deposit outflow is worse than expected.
Jason, how hard is it to get a full picture on the stability of this bank right now? Because the company also withdrew all of its prior guidance. They're not taking any questions on the earnings call. So how do you look at that from an investor perspective?
I mean, I'm not really surprised that they're not giving guidance because things are so uncertain. I really wouldn't have expected them to. So that's not really necessarily a disappointment. But what you highlight is, the stock continues to be very volatile. And the reason is that the future of this company is very uncertain. So, there's some potential that they can sort of right the ship and, shrink to the point where they are sort of profitable on the business that they've retained. And then there's some value, perhaps even greater than book value going forward, if you assume that kind of rebound. But on the other hand, it's going to be very difficult for them to do that because their cost of funding is so high. They're no longer an investment grade bank, which is a real challenge in this industry. And so, they continue to, at the same time that they are operating the bank, they're looking at their strategic alternatives and who might they be able to partner with and sort of get a rescue from. And all of this is ongoing. There's many different ways it can go. And that's why as investors sort of change what they think the probability is of these different scenarios, the stock moves so violently as perhaps we're seeing after hours today.
Jason, the Fed whisperer, as we call him, Nick Tamiros, writes in the Wall Street Journal over the weekend why the banking crisis isn't over yet. He's citing the former Dallas Fed president, Robert Kaplan. How do you think this banking crisis will continue to play out in the quarters ahead?
So we do think that there's been some stabilization sort of from the worst throes of this crisis earlier in March. And so you can see that, for example, if you measure, there's something called the forward rate agreement overnight index swap spread, and that will tell you it's a measure of bank funding costs that includes credit costs, and it peaked, in early March, and it's come down to sort of its 10-year average, actually, so that seems very reasonable. Similarly, we look at the Fed's balance sheet disclosures weekly, and they disclose how much crisis borrowing there is by banks, and that number peaked about a month ago, and it's been coming down weekly ever since. So these are signs that things have stabilized. I think what perhaps Tim Reyes and Kaplan were referring to is the next phase of the crisis could have to do with commercial real estate. And we know that banks lend to commercial real estate. They're an important source of funding for that market. And so if we were to see sort of banks pull back, it's not clear who would step up and there could be defaults. And so and there have begun to be some already. For example, Brookfield, the real estate investor, has defaulted on some loans. And so this is an area where, perhaps it could, again, make investors nervous and reignite the crisis. But so far, things have stabilized from where they were in early March, and there's no, this is more of a long-term thing that could play out over quarters rather than something that's imminent.
Yeah, Jason, talk a little bit more just about those broader implications, just in terms of what we're seeing play out in commercial real estate. I guess, how bad could it potentially get?
Right. So, commercial real estate, obviously, it's a major market. And what's unique about it is that these regional banks are typically the ones that, fund it more so than other markets. And so they have a meaningful presence there. And then the bank crisis, what it's done is it's taken these, these regional banks and it's said to them, your funding costs are going to be higher in the future. There's likely to be more regulation coming down the road. And it's likely to sort of have them kind of rein in their activity broadly, but it will be most impactful in this sector. And then you can layer on top of that, if you just think about within commercial real estate, the office market, where vacancies are lower because of remote work trends. There's been a lot of construction in recent years. That's sort of vulnerable anyway. And all those things, these are the areas where the banks that are most exposed to those could be most impacted. Now, that's not First Republic. So in essence, First Republic shouldn't be so shaken by this type of activity unless, other banks were to become wobbly, and then it might spill over in sort of a chain reaction.
All right, we'll keep our eye on that. Jason Benowitz, appreciate you coming on, sir. Thank you. Lobbyists for the drug makers behind weight loss medications Ozempic and Mounjaro are pushing for the drugs to be covered by Medicare, but it may be a hard sell. Yahoo Finance's Anjali Kamlani here to explain exactly why this is a huge implication for these big pharma companies.
Yeah, well, the big explanation, of course, is the dollar signs. Medicare is 60% of the payer mix that these companies get, and so that is where their sights are set. We do know from a report from the Wall Street Journal that the lawmakers are not going to broad strokes necessarily approve this, but they're looking at ways that it could be approved, especially for those that specifically qualify, not looking at those off-label uses for weight loss, but those specifically that fall within that BMI index that it's been approved for. So that's where things stand there. Now, it's interesting to point it out, of course, because of the market for this. Earlier today, Meg Fitzgerald, who is a policy professor professor as well as one who watches the industry, said this about the market.
I mean, these are products that are going to be $40 billion a piece, if not more, because the population is so huge. Half the American population is technically overweight.
So with that as the potential market, of course, we know that the companies are going to be looking for a way to get that big payday.
Yeah, they are. And listen, you have lobbyists, you have corporate stakeholders. They're making it known that they are not pleased with the draft guidance on Medicare drug pricing negotiations. So what can you tell us about where that stands?
Absolutely. So to that point, on one hand, they're asking for it. And on the other hand, really not happy with the way that the draft guidance has come down. The largest lobbying group, Pharma, has said in a letter to CMS that they believe that the way that the Medicare draft guidance has come down is basically rushing the issue too fast and not a way for the companies to be able to catch up to it. We know that they've been talking about the potential of litigation for quite some time, and so this seems like it's the first steps with those public comments that have been submitted for the companies, for the lobbying groups to really set up what that pathway is and show kind of what they're going to be picking out when it comes to this expected litigation down the line.
All right, great stuff. Anjali Kamlani, always good to see you. Great reporting. Thank you. Coming up, we dive into the trending tickers moving after hours. Stick around.
Hello there. Do you want to know what's going to happen when After the Call goes live for the Microsoft and Google / Alphabet, Alpha Google, whatever you're calling them, when they report earnings? Hang on one second. Hey, Shauna. You want to tell them about After the Call?
Oh, here I come.
All right, we're going to fill you in everything that's happening.
All right, well, I'm going to be watching Microsoft because a lot of this buzz has all been about open AI. We know AI has really been the excitement word over the last several months. So we'll see whether or not some of that holds and if it's going to be enough to offset the slowing that we've seen in Azure, the cloud business there for Microsoft. It could be a worrisome quarter if maybe that comes in below expectation.
I'm also going to be watching Alphabet, Google, whatever you're calling them at home. Google CEO Sundar Pichai has already been vocal about where we need to maybe pump the brakes a little bit on all of our generative AI ambitions, or at least the tech companies and tech spaces ambitions as of right now. But perhaps we'll hear a little bit more on that on the call. But this is still an advertising business at the end of the day. As much as you might be interfacing with Bard or Ernie Bot one day, or whatever ChatGPT's name is going to be from Microsoft at the end, it's still going to come down to how they can monetize all of these things. And advertising has been the way, at least for Alphabet and their subsidiaries, Google, YouTube, the list goes on. We've got a lot to break down for you after the call.
All right, let's take a look at some of the stocks trending after hours. We got three names for you. First Republic Bank, Whirlpool, and Cleveland-Cliffs. Now, kicking off with First Republic Bank, we're looking at a loss of just about 20% in after hours trading. The regional bank reporting its earnings, and obviously this is closely watched given everything that has happened within the regional bank sector over the last 2 months. We're looking at losses in First Republic alone in the last 2 months of 86%. In the most recent earnings report for Q1, deposits there falling 40% on a quarter-over-quarter basis. The company also announcing that it's going to be cutting 20 to 25% of its workforce as it looks to get its costs in orders here. It also withdrew all of its prior guidance. The CEO not taking any questions on the earnings call. So we're looking at the bank under pressure in extended trading, off just about 19%. Flipping over now to Whirlpool, a bit of a different story there, up just about 3%. The company beating on both the top and bottom line. Also, its full year guidance coming in much better than what the street was expecting. The company saying that it did deliver significant sequential margin expansion. Now, over the last 2 months, we're looking at a gain of just about 1%. Over the last year, those shares in the red, off just about 19%. Of course, Whirlpool, the consumer connection there, so a stock that could potentially be under pressure over the next coming quarters. Cleveland-Cliffs here, the steel producer, that stock off just about 2% in extended trading. The company reporting a net loss for Q1, sales also declining, costs and expenses increasing there for the steel producer there over the last year, looking at losses of just about 44%. So a couple of names to keep in mind ahead of tomorrow's opening bell. Dave?
Big week. All right, Shauna, thank you. Closing time here at Yahoo Finance. Let's get you caught up on some of the biggest headlines of the day. Major news in the cable news world. Fox News parting ways with host Tucker Carlson, and CNN has let go of morning show host Don Lemon. Neither network has provided details about what led to the separations. Meanwhile, NBC Universal CEO Jeff Shell out after admitting he had an inappropriate relationship with a woman in the company.
Switching gears, Bed Bath & Beyond filing for Chapter 11 bankruptcy over the weekend, heading to the Beyond. The retailer received a $240 million loan to continue operations while it winds down the business. For those of you looking for a deal, store closing sales begin Wednesday, April 26th.
And finally, luxury goods giant LVMH has become the first European company to top $500 billion in market value. The company behind brands such as Louis Vuitton, Moet & Chandon, and also Bulgari has benefited from the strength of the luxury consumer as well as China's reopening. Now, LVMH founder and CEO Bernard Arnault sits atop of Forbes' real-time billionaires index, making him the richest person in the world.
All right, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern Time, for all your coverage leading up to and after the closing bell.